Bloomberg Audio Studios.
Podcasts, radio, news.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
All right, the big story, the geopolitical story of the day is tariffs. President-elect Trump looking to impose tariffs on a lot of our leading partners here. Brendan Murray joins us, Bloomberg Global Trade Editor. Hey, Brendan, you're the expert on trade. What do you make of this story here about tariffs?
Well, for those of us who covered Trump's first term, this was a bit of a flashback to a time when you might get a message from your boss at 8 o'clock at night saying he's done it again, and sure enough, the incoming president tweeted some tariff threats last night to the three biggest U.S. trading partners: China, Canada, and Mexico. The ones that stood out were the 25% tariffs on everything from Mexico and everything from Canada, which would essentially throw the U.S. economy into a tailspin, blow up NAFTA and its successor, USMCA.
So that's what I didn't understand, is Trump negotiated the USMCA in 2020 and signed it with Mexico and Canada. So why would he blow up his own agreement? Yeah,
that's a good question, because these threats aren't intended necessarily to be promises that eventually get fulfilled. They are threats, they are bluffs, and they're meant to drive the other party to the negotiating table. So he will have plenty of advice. If this goes to January 20th and he's still threatening this, he'll have a lot of advisors around him saying, you're going to destroy the U.S. auto industry if you do this. So there's a lot of time between now and Inauguration Day. Maybe there's some negotiation that can come out of it. He's already gotten a call from Justin Trudeau in Canada. The Mexican leader said just a few minutes ago that Mexico will respond with its own threats. And she said, the main exporters from Mexico to the U.S. are General Motors, Stellantis, and Ford Motor Company. So, there's the big auto companies there. So we'll see what happens. But, markets had a reaction, but it's nothing too drastic. 18 hours afterwards.
All right, Brendan, thank you so much. We appreciate it. Brendan Murray, he's global trade editor for Bloomberg News, joining us from London via Zoom. So I think some of the reporting I've seen today, Alix, is potentially using tariffs as a bargaining chip for other issues down the line.
Literally, it's a deja vu of 2016. Exactly right.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
All right, headed back to the market here. It is earnings craziness, particularly when it comes to retail. We got tons of news out here. Ross Gilbert, Bloomberg Intelligence, senior equity analyst, is joining us in some of those retail earnings. Can we talk about Ross stores Kohl's, right? Yeah. Kohl's, what happened here with Kohl's? I get the weather situation, but I mean, is it a real thing or is this the excuse of the weather?
No, so with Kohl's, it wasn't a weather thing at all. It was an execution issue. So the company reported comp sales down 9.3%. What that means is that their core business, the core apparel categories, they were down in the double digits because Sephora beauty sales on a comp basis were up 9%. So what happened in the quarter? What was the miss? It was on the private label side. So as the company was bringing in some new categories, including 200 Toys R Us shops in the quarter that they opened, plus they have some home decor impulse items that they've brought in. And in so doing, they drew back on their private label and then also petites, and that really cost them dearly in the quarter. Since then, they have made improvements, and they saw toward the end of the quarter a 500 basis points improvement in the comp sales decline. But this basically led to them naming a new CEO. They have brought in Ashley Buchanan as CEO. He's with Michael's Stores, and he's known for improving the profitability and turning that business around. He also has had stints at Walmart as the chief merchant of U.S. e-commerce and also the CEO of that e-com business in Walmart. So he really brings a lot to the party.
Wow, there's a lot of moving parts there at Kohl's, and as you mentioned, one the big issue is execution. What did the company say, if anything, about their core underlying demand out there? I mean, did you give it any read on the consumer?
Yeah, I mean, the reason why they missed on the private label is because those are more open price point items, and that their core consumer is sort of that lower to low middle income consumer. So they're earning under 50,000, under 75,000. And while they will draw on some higher end consumers, the core consumer is really, they have less discretionary income in this environment. And then there's so many other choices out there with off-price, mass merchants. We had great numbers that came out of Walmart and their apparel category doing well. So I think that's where they've had the miss, but they've really stepped up engagement with their core consumer, and they're seeing that that's really, helping the sales there.
Is this just though a matter of, say, Walmart? I mean, TJX is a little bit different, but let's just say Walmart doing really well with over 100,000 and under 100,000. They're a one-stop shop. Is it really a Walmart story?
No, it's not really a Walmart story. It's a Kohl's execution story.
Okay.
That's really what happened.
What about Abercrombie?
Here's a different story. Abercrombie and Fitch hits it out of the ballpark again with comp sales up 16%. Hollister, which is their Gen Z brand, was up 21%. Analysts were expecting 11%. This company did not say weather was an issue for them. They said that they always believe that they need to have balanced categories so that weather isn't a factor. And of course, it is a global business, and they were doing well across all markets, including China. So they were also up in China as well. So Abercrombie has a very different story, just superb execution. They have all the categories that their customers want. They introduced Your Personal Best, YPB, which is kind of like a Lululemon alternative for their customer at more amenable price points. And it's second full year of that business, and it's continuing to grow. So they're giving their consumers what they want, and it's showing up in the results. So quite a different story with Abercrombie.
So the stock's off 5%, but I see that the stock was up 66% year to date. So is this just a little profit taking today for Abercrombie investors?
Yeah, probably a little breather. I think they're going to continue to execute going forward. And then when you think of the big headlines right now with tariffs, with Abercrombie, their tariff exposure for imports coming from China into the U.S. is only like 5 to 6% of sales. And they could also dial that back further if necessary.
When it comes to an overall macro takeaway, so that's the unquestioned, right? We don't know what the tariff situation is going to be. What is our macro read on the retail names that you cover? Because as you made it clear, like the Kohl's is execution. So can we really take something away? What's your broader take here?
Well, based on most of the companies that have reported so far, weather has definitely had an impact. So for example, we also had Burlington Stores, which is in the off-price space, and it's one of the fastest growing because it's so small, and they're opening up about 100 stores every year. And their comp sales rose just 1%. Analysts were expecting 2.2%, but they said, look, winter weather categories make up about 15% of our sales in the third quarter. So if you strip it out, our comp sales were really up 4%. So they are saying, hey, we were prepared for the weather, and we didn't get it until we moved into November. So I think most of the companies that have reported, including TJX, which had great numbers, but they also missed a little on the comp sales, and it was due to weather. So that's been the underlying, I think, factor, and I think we'll probably hear it coming out of Nordstrom when they report after the close today too. But we do think that Nordstrom could beat estimates, but we'll see when they report later.
Hey, Mary, when all is said and done here this holiday season, how do you think it's going to turn out from a top-line number?
I'm very optimistic. I think the consumer has proven to be very resilient, and if you have highly desirable apparel, you're going to get the sales. And clothing is a big category for the holidays, So it's the second largest, second to, let's say, electronics. So I think it's going to perform well. If you look at a lot of the holiday dressing that's out there, it's pretty exciting. We now have cool weather that is set in most parts of the country. That's good news. That's going to draw sales. And that's actually based on our consumer survey that we conducted recently. The number one driver, second to discounts, is weather, the change in weather. The change in weather does cause consumers to go out and spend money on new clothes.
So like we make fun of it, but it's real, I
real.
guess.
It
I mean,
is.
whenever I see the weather thing on an earnings release, I'm like, sure. All right, thanks a lot. We really appreciate Mary Ross Gilbert joining us from Bloomberg Intelligence.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
Peter Tchir joins us, head of macro strategy, Academy Securities. Hey, Peter, you and your team, you woke up Wednesday, November 6th, the morning after the election, and when it became apparent that President-elect Trump was going to be the next president and that we would have a Republican-controlled Congress. To what extent, if any, did that alter the way you guys think about investments going forward?
I think for us, there's two things about it, right? One, what's it going to do on the geopolitical landscape? What's it going to do on the domestic landscape? And what will that do then for our investments? And I think really it takes us to really being all in on commodities. We think commodities, whether it's rare earths, critical minerals, oil, are going to be supported by this government. I think you're going to see some activity in the chips. I think you're going to see kind of a national security type level thing where, one, we impose some tariffs, maybe strategically, but also we actually provide some supplements and some boost to the companies that we need to do things domestically. And I think one of the big things that's going to change is not in my backyard. We're going to review a lot of the rules that have been in place over the last 10 to 15 years that were done when there was the luxury that the US was the sole superpower, that are going to be rethought a little bit in terms of, hey, China's an economic superpower. They're fighting with us. What are we going to do about it?
Well, Peter, what's interesting, though, when you mention commodities, is that the result of all of this can also be a stronger dollar, which could be negative for commodities. How do you square those two things?
So, in fact, I think you're right. I don't think commodities themselves are going to do particularly well, but the commodity-related companies will do very well, right? They're going to be allowed to produce more. They're going to be allowed to make profits. So I think you want to continue to play in those stocks. I look at XLE, for example, on the energy space. That has continued to do well, even while oil itself hasn't done well. So this is much more a play in the companies themselves because they're going to be able to produce more. And I think anyone who does, services should do very well. So I think that's the play. It's not in the commodities itself. It's in the commodity-related stocks.
Peter, overnight we had a bunch of tariff discussion coming from the president-elect. How do you think about tariffs, and does that impact maybe sectors you look at around the world?
So right now, I'm not overly concerned about tariffs. I think Wall Street coming into the election just took every worst thing, than Trump on the campaign trail said about tariffs and came up with these kind of ridiculous assumptions. How I see it is he is trying to negotiate this. And I think one change we have to remember is Trump is going to say this right up until the last minute, right? He can't say, hey, don't worry about this. I'm just faking to get them to the table, because that would lose all the power. He does have the benefit that he actually did put tariffs on in 2018, which at the time, a lot of economists said were awful. We said we weren't starting a trade war. We were only fighting back for the first time. None of those economists complained in 2020 when Biden left those tariffs on. So I think this is more a negotiating ploy. We'll bring China to the table. We'll bring Canada, Mexico to the table. I think with China, it's pretty easy negotiations right now. I think we can't give in on anything on high tech. We can give in on things like food, and we will try and work with them. And China's probably going to have to absorb some of the costs of whatever get implemented because their economy is not so well. I would say discussions around the world, it's Mexico that just seems we should be thinking more about tariffs and more about how do we really work with Mexico to create a robust environment or an industrial manufacturing base that we can utilize.
Right. Yes, exactly. Ensuring that base won't be really going away. How does this all then translate to the bond market, right? Because in terms of narrative storytelling, the story was, Scott Bessent, we like him. That's going to be good for Treasury. Thus, we want to buy Treasuries a lot and yields go down. Then today, we have tariffs. Maybe that is distressing. We're going to sell a little bit in the belly. That's the narrative. What's the correct narrative?
So I think at 450 was pretty obvious. Even 445, you should be buying Treasuries. I think we get down to 10, 410, 415, partly because I think people got ahead of themselves on deficits. They got ahead of themselves on tariffs, and some of that's getting walked back. But I also look very closely at positioning. You have spec short interest is very high in treasuries. You have a lot of the CTAs are allegedly pretty short treasuries. You had even seen kind of retail coming out of some of the long end duration. So I think people kind of got whipsawed, are badly positioned. So I think you get to 410, maybe 415, that range on tens. And then you want to start shorting again because the story won't be rosy next year, but people priced in way too much, way too early.
Credit risk. How much credit risk, if any, do you want to take? Because I note that the best performance in fixed income has been U.S. high yield and U.S. leverage loans.
Yeah, I think you continue to take credit risk. And I've looked at it from two standpoints. One is at the high quality end, I think more and more people are overweight, short dated corporates versus T-bills, right? You still don't know what's going to happen with debt ceiling, things like that. And then at the long end, you have this really neat competition, right? You have all this private credit pushing in. And then I think you saw a lot of banks pull back on their lending after Silicon Valley Bank. So what they've had to do is now catch up. So they're lending. So you have a lot of support for this. And, I'd be more worried about the leverage loan than the high yield bond market. I think, one thing I really get frustrated, I see a lot of charts, 10, 15, 20-year charts on high yield. It's so not the right thing to look at. The high yield market used to be very small issuers, companies that you didn't know. Almost every issue in the high yield market now is big. They have public equity. It's hard to get surprised. So I think that makes sense. Leverage loans, I think, are a little bit, where you have more one-off trades. So I would be probably moving out of leverage loans, focused on, the high yield. I think, some of the business development corporations could be interesting, but I'm very comfortable with credit here right now still.
Peter, so great to catch up with you. I mean, it's like any question you ask, you have an opinion and answer, and they're usually right. All right, Peter Tchir, head of macro strategy at Academy Securities. Thank you so much. Really appreciate that.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Let's go to some biotech here. So you have Amgen sinking after its weight loss drug maybe wasn't as good as expected, even though it still delivered some solid results. You also have Novo Nordisk and Eli Lilly rising, potentially the Biden administration proposing that Medicare and Medicaid cover the obesity drug. So who do we go to? We go to Sam Fazeli, Bloomberg Intelligence Director of Research for Global Industries and Senior Pharmaceutical Analyst. Hey, Sam, how real is this Biden proposal, do you think?
Well, look, Alix, the $35 billion number was floated a little while ago as to the cost of this to the system over 9 years. It's not exactly a large number, right? If you could genuinely get a significant number of people at the sort of ages that they are in the Medicare program, reduce their risk of cardiovascular disease, reduce their risk of sleep apnea, the kidney disease, which is what these drugs do, I think that's a win. So I think this is a really good possibility for it to happen. Obviously, President Biden wants it to happen. The question really is whether the next administration is going to try and reverse it, or would there be appetite to continue with it?
All right, we're speaking weight loss drugs. What happened to Amgen? It's rare that I see these guys swing and miss here.
Well, Paul, I think we've seen this movie plays over and over again. Companies say we've got a great obesity drug, and let's be honest, 20% weight loss isn't bad, and side effect profile, okay, maybe a little bit worse, but this was a dose escalation trial, etc., etc. The problem is everybody gets that sort of level of efficacy. How are you going to compete against the might of Novo Nordisk and Lilly when they come to market, where they've got all those indications I just talked about? Sleep apnea, cardiovascular risk reduction, kidney osteoarthritis, and they've been on the market for X number of years. Novo Nordisk, with the diabetes indication included, well over a decade. So how do you compete? You need better data than that. And somebody might say, okay, well, it's a once a month drug. Well, really, once a month versus once every week with a pen that you don't even notice you're using? I think that's what a lot of people would say. So that's where the issue is. They needed to really hit a home run, and they ran also ran instead.
So do you think so what's going to take for them to not do an also ran?
I'm pretty sure they're going to continue to do the trials.
Okay.
Maybe they'll find that they can extend to every quarter instead of every month. Then that becomes a little bit more interesting potentially. But at the end of the day, a lot of these drugs, we saw it with Roche, we saw it to a degree with AstraZeneca. They come up with the excitement, oh, we got a new drug. Although at least Roche and AstraZeneca have some oral versions. I think these guys maybe are also looking at an oral version. The news comes and you go, oh, okay. So
Right.
What does it take? It needs to be significantly different.
So about the oral version, taking it via pill, just asking for a friend, by the way, when are you guys going to come up with that? Because I just consider you're big pharma.
Yeah, I am big pharma. Look at me. No. Look, oral. I think it will come. There are drugs in development, and they're going to go through it, and they'll come. Again, what are they useful for? Because nobody seems to bat an eyelid to take an injection once a week. Again, as I said, these needles are very fine. So most people say they don't even feel it going in. Not everybody. Some people don't like a needle.
Well,
Some
I'm
people
the
don't
one-
like an injection.
I'm the one that applies the injection.
And
It's
Right.
fun. I enjoy it. It's
What does that
it's
say about
happening. Yeah, we do it every Saturday. I get an adult beverage, a cocktail. We gather and we do the injection. We kind of make a little party out of it.
This is a group activity, is
Yes,
it?
it is. It is. All right, Sam.
Small
thank
group,
you.
but yeah.
Thank you so much. Sam Fazeli, he's a director of research for Global Industries. I'm not sure what that is, but I know he's a senior
He's the boss.
pharmaceuticals analyst for Bloomberg Intelligence. He's one of the best in the city of London, highly regarded in London and in the U.S.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Alix alongside Paul Sweeney, Bloomberg Intelligence Radio. We are broadcasting to you live from Interactive Broker Studio right here in Midtown Manhattan. So we hit a record high yesterday on the S&P, didn't close at a record high. We hit another record high today on the S&P, and Deutsche Bank comes out with its S&P forecast for next year at the high end, 7,000. It is one of the most bullish forecasts over on Wall Street. Let's talk to Anna Rathbun now, a CIO at CBIZ Investment Advisory Services. Anna, are you also going to be like, hey, 6,600 next year, 7,000? How bullish are you?
Well, I don't know if I would do that at 22x forward PE multiples. I think a lot of what's happening in the markets right now is just euphoria. For one reason or another, there's promise of tax cuts. There's this idea that the tax cuts from 2017 are going to be extended, especially because we have a red wave. There's promise of deregulation. There are no details right now. So it's sort of running on fumes. But once we have the details in 2025, we're expecting there to be a lot of volatility as the markets start to price in those details. So sitting here at 22x PE multiple, I'm not necessarily thinking that it's going to be a road straight up.
So the day after the election, Anna, did you and your team make any material changes to your outlook, your asset allocation? How did you guys try to process that?
In terms of asset allocation, we did have a little bit of an overweight in small cap because we believe that if Mr. Trump had won, that the upside would be greater than the downside if he hadn't won. So that worked out for us. It's still working out for us. But in terms of outlook, you have to sort of ask how much of this euphoric outlook is actually going to take place. And we don't know if there's going to be an actual fundamental change to the U.S. economy in the boots on the ground kind of fashion that it would actually make us think differently about the labor market or think differently about prices, because one person in the White House can't change that. So we're still a little bit skeptical about a lot of this enthusiasm, but I guess only time will tell.
So this was a total redux from 2016, right? Like you'd get a tweet, you'd get an instantaneous stock move or an individual stock move, and then you'd have the wait, maybe this won't be the end goal. Maybe something will change, and then sort of a paring back of the market reaction. How do you avoid that this time? In that, are there places you can go where you don't have to worry about the tweets?
I'm not sure. I'm not sure if we can hide. I mean, if 2016 to 2020 taught us anything, that these tweets, or I guess it's Truth Social or whatever platform it is, it's gonna come. Now, I think the people that Mr. Trump has surrounded himself with will make a difference. And as we saw yesterday, there's a lot of confidence in Scott Bessent. And I think some of the news that came out on the new tariff threats, that will also probably involve not just the Treasury, but the Commerce Department as well, because the negotiating factor here isn't economic. The negotiating factor here is drugs and immigration, and it will impact certain industries more than others. So I think there's going to be, hopefully, a group effort in looking at some of these, so-called, tweet-based policies, and it will continue to be measured, and that is definitely a hope.
Fixed income space. Anna, how do you think about this? Do you stick with the 2-year Treasury at 4.25%, or do you go out there and try to take some credit risk here?
Yeah, we've had credit positions, both on the investment grade side as well as high yield side. Their sizing is different. We favor investment grade because I think that the credit spreads are narrow, and that does worry us a little bit, and we have taken some chips off the table. But we do think that as long as the economic growth seems to be in place, that it's going to be fine. And in terms of clipping coupons, we can continue to clip them. In the high yield space, we are a little bit cautious because there tends to be an equity beta component to the price movement when things do go wrong. But in the meantime, we can still continue to clip coupons. So right now for us in fixed income space, it is really a clipping of the coupon environment.
Yeah, and then just kind of watching and waiting and seeing when that trade will reverse. I want to get your take on small cap. So record high yesterday, mid cap, same deal. Now the Russell is down 1%. Clearly is a tariff overhang here. What do you do with those really economically sensitive parts of the market? I mean, materials and industrials are one of the worst performers in the S&P.
Yeah, so small caps, I think the ride up, I mean, we're enjoying it right now, but we're also internally talking about, okay, what do we do with this overweight position? Because the headwind for small caps isn't gone because Mr. Trump got elected. I mean, maybe there may be some deregulation that would be helpful, but remember what's happening in the Treasury market is that yields are heading up. I mean, we're seeing that today with the whole trade talk or tariff talk. That's not going to be helpful for small caps. And certainly tariffs, as we see today, aren't going to be helpful for small caps. So I think there needs to be, we can have exposure to it, but there needs to be an intelligent discussion about what the right sizing is.
Thank you so much for joining us, Anna Rathbun. She's a Chief Investment Officer for CBIZ Investment Advisory Services based out there in Ohio, right in the Cincinnati area there.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Alix Steele and Paul Sweeney. We are live here in our Bloomberg Interactive Broker studio in New York City. We're streaming live on YouTube, so head over to youtube.com, search Bloomberg Podcast. That's where you will find us. Well, the retail earnings, they are coming in fast and furious. Right now, we're going to take a look at a couple of them. Best Buy and Dick's Sporting Goods. Best Buy, a little bit weaker, stock trading down about 6%. Dick's Sporting Goods, however, they strong back to school. Stock's trading a little bit higher here today. Stock's up 47%. Dick's Sporting Goods year to date. That's a big move for a retailer. Lindsay Dutch joins us, consumer hardlines senior analyst for Bloomberg Intelligence. She is safely ensconced in our Princeton University campus down there, down at Princeton. Lindsay, thanks so much for joining us here. Let's start with Dick's Sporting Goods. They called out strong back to school sales. That's a good sign.
Yes, thanks for having me. I think Dick's had a strong quarter, again, stronger than expected, sort of continuing the trend that we've seen earlier this year. They have, the items that kids these days want in footwear, athletic apparel, and their exclusive sort of vertical brands are also doing very, very well. And that really supported that back to school. And it gives a lot of optimism when we think about holiday in the fourth quarter coming up.
So I realize that Best Buy and Dick's are different stores, but the way you describe Dick's Sporting Goods, it feels like it should have been the same for Best Buy, right? Back to school, they do have some exclusive items, etc. Why not?
Yeah, so I think that's a great question, Alex. I think, when we think back 3 months ago, Best Buy had a great quarter, and it was on back to school. For them, back to school is a little bit more college bias. It does hit a little bit earlier in the year than Dick's might benefit from. And the demand for laptops was very strong in the second quarter. And, Best Buy raised their guidance. There was strong optimism that we were going to get back to growth mode. I still think, there's a possibility for a strong holiday for Best Buy. Laptops they were up, comp sales 7% in the third quarter, but that was overridden by weakness in some of the other categories, appliances, home theater being key ones. It sounds like they're really leaning into promotions for the fourth quarter and really looking to get aggressive with promotion, especially for their premium product and things that are exclusive to Best Buy to really draw that shopper in.
How's it, when you talk to your retailer and companies that you cover, Lindsay, what are they saying about just this whole holiday season? When all is said and done, are we going to have growth this year? If so, better than last year? How are things shaking out?
Yeah, so growth looks pretty weak. I also think it's divergent, sort of like last year. So there's some categories that are just in a better position. Beauty would be one of those. Sports, where Dick's is playing, is also one of those where just demand generally is a little bit stronger. And then we have other categories that are still on the weaker side: home, appliances, and some of that still, obviously affects Best Buy. It also affects companies like Williams-Sonoma, RH. We also have a bifurcation, I think, in the consumer. A higher income consumer still seems to be holding up pretty well. Dick's is another benefactor there. Their customer base is on the higher income side, whereas Best Buy is probably a little bit more like the average of the overall country. So I think, the deal days that these companies are rolling out, they each have their own strategies on how they want to manage that. But as I said, Best Buy is going to get very aggressive with those deals. The consumer, high or low income, is very value focused. And we may have seen a pause, people holding back, waiting for those deals in the third quarter results.
Yeah, it's like she's describing me.
Exactly. Hey, Lindsay, how about from an industry perspective? If I ever find myself going into a store, which I hope that doesn't happen, am I going to find the stuff I'm looking for? Like, has everybody got the inventory they need here? I don't hear too many, supply chain stories anymore.
Yeah, so the supply chain woes of COVID have sort of gone away. I think, retailers, maybe a little over a year ago were probably over inventoried. I think inventory is in a healthier position this year, for the retailer themselves, but also for the shopper. And I think that the retailers are working really hard to make that in-store experience a positive one for those that go in store. But there's also a lot of focus online. So that online shopper, Best Buy is doing doorbusters again this year, but it's for that in-store shopper. But also, if you are a member and have the app, you could also take advantage of that. So they're really looking to, capitalize on that experience.
What about tariffs? So if we do get tariffs on China and Mexico and Canada, like we heard on Truth Social yesterday, what was the impact? How do they manage it?
Yes, so Best Buy, they have talked about, as big picture, as a percent of COGS, about 60% of their inventory, is manufactured in China. That's about the same as where it was in 18 and 19. For the products that they have direct control over, the exposure is low, and they've sort of managed that down. And they discussed on the call this morning that, the burden of that cost is really going to be shared between the manufacturer or supplier, the retailer, and possibly the consumer, if it comes to that. Dick's exposure is pretty low. When I look across my coverage, Elf Beauty stands out. They have 80% of their supply chain is manufactured in China, very highly exposed. A company like that is looking to lean on price increases to sort of manage that type of cost.
So tariffs are inflationary? Is that what I'm hearing?
That's weird.
Okay.
I didn't know that.
All right.
No one talked about that before. But again, what we actually wind up seeing, et cetera, is that one of it being different. Lindsay, thanks a lot. Lindsay Dutch, Bloomberg Intelligence Consumer Hardlines, a senior analyst joining us on Best Buy and Dick's Sporting Goods. All I heard was that Best Buy sales are coming, but then I have to go there. I don't want to do that.
But, yeah, well.
Maybe a member or something along those lines.
Right.
This is the Bloomberg Intelligence Podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live each weekday, 10 a.m. to noon Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.